Welcome back to the monthly portfolio update. I hope you find this information useful, but disclaimer, please note that this is not investing advice. It's just my portfolio as it stands on Thursday, July 4th. By the way, happy Independence Day for our American friends. But to continue the disclaimer, meaning the portfolio, can change at any time without previous notification. Following an investment strategy without doing the work yourself is almost guaranteed to result in losses. So please be careful, since it's your responsibility to do your own research before investing. At the end of the video, in the bonus section, we will discuss about the paradox of risk in investing. Sorry that the video came out a bit later this month, but I was traveling out of the country. All the data presented is a snapshot of July 4, 2024 instead of a usual first of the month, but it shouldn't make too big of a difference long term. Anyways, without further ado, let's get into it. This month I continued buying assets since so far I just reinvested slightly less than 20% of the money from the Transgas exit, which by the way is up 13% from my average selling price, but we can't always pick the top. I am happy with the average price I got for the position, especially in the light of how big it was. So, I reinvested some of that revenue in Nuclearelectrica, the Romanian nuclear energy provider, and built up my new positions from last month, Evergent Investment and Holde Agri as well. I also got a little bit more altcoins via the Learn and Earn program, launch pools, and other such programs that I'm into. This was a slow month. As mentioned, I was on vacation and also had a bad water leak in my apartment, so was busy on the other fronts. In terms of cash flow, I had a very good month with somewhat significant dividends from Aquila, BRD, Nuclearelectrica and Hidroelectrica, and a very insignificant dividend from Transport Trade Services. So, the portfolio as of July 4, 2024 is looking like this. Pause the video if you want to analyze each investment in detail. As mentioned, only 3 trades this month, all buys, and the positions are at lines 6, 12 and 13 in the Excel. That being said, the current pyramid allocation portfolio looks something like this. The biggest loser this month was crypto, but stocks picked up somewhat the losses. This month, the valuation of the portfolio was insignificant in terms of variation, minus 0.1%, including living expenses. And year to date, the portfolio stays at 6%, 5% profit plus the 1% new money that came into it. Before going to the next section, if you are interested in the subject matter, you can leave a like and subscribe to the channel. It really helps bringing this completely free information to more and more people. In today's bonus section, we discuss about the paradox of risk in investing. If you find the subject interesting, there is also a pinned comment with an older video where I discuss the concept of risk overall in more detail. You can check that one out as well. So, how should we approach risk when investing? First, let's define what is risk. The dictionary definition of risk is the following. Risk, noun, a situation involving exposure to danger. According to Investopedia, risk is defined in financial terms as the chance that an outcome or investment's actual gains will differ from an expected outcome or return. Risk also includes the possibility of losing some or all of your original investment. Quantifiably, risk is usually assessed by considering historical behaviors and outcomes. In finance, standard deviation is a common metric associated with risk. Standard deviation provides a measure of the volatility of asset prices in comparison to their historical averages in a given time frame. This is represented by the risk-reward curve shown over here. The logical conclusion from the graph is that the more risk you take, the greater are the returns. Of course, there is a significant flaw in the standard way of thinking about taking more risk leads to automatically making more returns. If that was true, it wouldn't be considered quote-unquote risky. As Howard Marks said, earning high returns in absolute terms or relative to other investors in a market requires that you bear meaningful risk, either the possibility of loss in the pursuit of absolute gain or the possibility of underperformance in the pursuit of outperformance. In each of the cases, the two are inseparable. He adjusted the previous risk-return graph to actually showcase the possibility of loss or underperformance for each individual bet. The conclusion being that the more risk you take, the greater are the returns, but also the bigger the chance of ruin or at least underperforming your selected benchmark for a period of time, sometimes years. The paradox of risk is that if you want to perform, you have to take some risks. As Wayne Gretzky, the famous hockey player, said, you miss 100% of the shots you don't take. There is such a thing as the risk of not taking any risks. Because the future is inherently uncertain, we usually have to choose between three options. We can avoid risk and having little or no return. I've done this for years with the money when I was employed. Or taking a modest risk and settling for a commensurately modest return, or, last but not least, taking on a high degree of uncertainty in pursuit of substantial gain, but accepting the possibility of substantial permanent loss. Not having any losers in your portfolio isn't a useful goal. The only sure way to achieve that is by not taking any risk, but risk avoidance is likely to result in return avoidance. So, what should we do? As successful investors, we should need to be comfortable with taking risks and accepting the idea that we need to live with some losses in our portfolio. Warren Buffett mentioned in one Berkshire Hathaway meeting that only about a dozen actions he took during his very, very long investing career made a real impact on the returns of Berkshire Hathaway. But he had to take the others as well to know when to make those important ones. The best one, as an example, would be when they bought Coca-Cola for the power of the brand after they had the experience with See's Candy. And if the god of investing only had 12, what about us mere mortals? Well, the bad news will be that we will make bad decisions. There is no shooting way to 100% reduce the risks, but we can mitigate them by using tried and tested methods that survive the passing of time during multiple different market cycles. First, we must try and not take unnecessary risks, like buying because we're bored or from fear of missing out, etc. Then, for each asset we own, we need to do an in-depth analysis. Don't invest in X asset because me or another talking head on TV said so. Next, always have a margin of safety. Diversification also helps. Some of your trades will be losers, some will break even, some will be winners, and some will be huge winners. That is why it's good to have some asymmetric risk-reward bets. And there are probably many others. Let me know in the comments how do you mitigate risk in your portfolio. Finally, I leave you today with the following advice from the same Howard Marks. You shouldn't expect to make money without bearing risk, but you shouldn't expect to make money just for taking risk. You have to sacrifice certainty, but it has to be done skillfully and intelligently and with emotion under control. Now you have to take into consideration that Oaktree just took over Internazionale Milano due to the fact that they couldn't repay a loan, and I'm pretty sure that they didn't want to get in the football business. So, nobody is infallible, but the advice is sound in my opinion. That's all for today. I hope you liked the video and got a new way to look at risk. Don't forget to like and subscribe, and see you next month. Bye bye.